time since I've looked at these charts, and actually, given the type of year that 2016 has been, I don't know about you guys, but certainly having a bit of an extended break over the weekend has been needed, deserved, and would hopefully do my trading no end of good. It's been a pretty exhausting quarter. So, welcome to quarter two. Quarter one was what I would call schizophrenic in terms of market activity, where we saw the S&P fall by 15% before then rallying again 15% back towards those all-time highs. Remember, guys, now we're on the June contract on the S&P. So if you are going back and looking back at patterns that include November and December last year, you'll need to look at your continuation text to make sure you roll over. But what a hell of a year it has been, and you could perhaps mistakenly look at this as something to do with oil, and I think oil obviously has been a big player in this volatility, but it's not all about oil. Oil coming off this morning slightly, breaking below the low that we had just there at 38.85 or so yesterday. So oil below yesterday's lows. So you could give this schizophrenic market the rationale that it's moving with the oil price. But as I'll talk about a bit later, I think it's a lot more to do with central bank expectations. Anyway, oil trading on the back foot this morning. We're coming quite down to some quite interesting levels. I think the one you have to keep an eye out on now, and this is on CLE of course, is 38.21. So this was one of the support levels back in December 2015 that we found before breaking through aggressively at the start of the year on those Chinese growth concerns. That was the week when the Shanghai comp was closed 7% down. We've tested it a number of times since breaking above it, haven't we? We tested it back in the beginning of March, once, twice, three times, 4, 5. We tested it again back on the 24th, and it looks like we're going to come down and look at 38.21. Again, much like as I was saying with the S&P, I think this is quite an important platform for oil. If you are bullish on oil and you haven't been able to get hold of anything yet, then 38.21 might be an interesting level for you. Well, why would you be looking to go long? Well, sadly, over the weekend, or just this morning, on BBC News 14 minutes ago, a hijacked plane has landed in Cyprus. This is coming out of Egypt. More militant activity in Egypt. Now, this has only just broken, really, so we need to find out some more things about it. But 81 passengers on board the plane leaving from Alexandria to Cairo landed now safely in Cyprus, but the hijacker themselves has yet to make any demands. Now, obviously, this is a very delicate type of situation, this sort of hostage situation. Allow these hostages to get out unscathed. It's a terrible time for those people on board, obviously. The difficulty is, if this is a IS militant, then his, who knows what his demands might be, but they could be totally irrational and impossible to deal with. So our thoughts go out to those on that plane in Cyprus, in Larnaca, the main airport in Cyprus at the moment. Just waiting for news on that. Don't expect this to, as yet, be a trading opportunity, of course. Not even in oil. I mean, oil's on the back foot of this. To me, it really does, still justify why I am bullish. The other commodity, gold, which is having quite a difficult time in the last week or so. There seems to be more and more of these events, these type of events happening. Whilst this is happening on one side, over the weekend you saw the atrocious activity in Brussels, obviously with the far right coming to deface the memorial made to those killed in the bombings in Brussels just not so long ago. And it does seem that one of the fears that I have is this growing nationalization the far left and the far right, leaving no middle ground. And the only thing we'll see from that is further conflict. So I've talked about oil just on the back foot. I know a few of you are interested in gold. Well, 1200 is really obviously the key level there, and as long as we're above 1200, I am still happy to stay bullish on my outlook for gold, but it all depends on one thing, and that one thing is the US dollar. And the US dollar's had a topsy-turvy session as well. Jan, I know you're in cable this morning. For you guys that have been trading, well, you see you didn't miss anything on Friday or Monday, really, until actually late on yesterday. We did get that surge higher in the euro versus the USD, but if we look slightly longer term here on the euro, let me just go to continuation settings here. Going all the way back to September, October, December, we've got these sort of areas, haven't we, of valuation on this euro USD. This was Mario Draghi, more dovish Mario Draghi in February. Then again, this is looking at Mario Draghi. Then we had Mario Draghi and then the Fed 2 weeks ago, one following the other, bullish for the euro versus the USD. But in general, if you look at analyst reports, most people predict and most people are expecting a continuation of the strengthening US dollar. And that's going to be important coming up for this week. I mean, last week, really, the main movers were Fed speakers, weren't there? From whether it was a hawkish Lacquer, we had Lockhart, we had Williams, all hiking that we would see an interest rate soon. What I find frustrating about this from a trading opportunity is that you had Yellen come out the week before saying only 2 hikes, not 1, giving that dovish angle. So let's say if you're trying to get on a momentum position, if you're a hedge fund with a 3-month outlook, let's say, you're trying to get on that momentum move of now a more dovish than expected Fed. The week after, then obviously her key members are giving a more hawkish signal, and I know this is what the central bank should do if it doesn't really want to give any signal. And it can be difficult to trade in this environment when it almost seems like the central bank doesn't really know what it's doing. So it really is still keeping all of its options open, of course. One of the impacts of this, I find, is that you get crowded trades. And by that I mean, if you have a look at the Euro USD, and you saw this in oil quite significantly earlier this year as well, you'll get a sharp move as everybody piles into one piece of communication, and then almost as quickly everybody piles out again as that communication gets reversed, which is good because it gives you momentum if you're on it, but you have to be ready to take profit when it's there. And this is something that I've been talking about all year, not holding on to positions for too long because things are reversing just too fast. I mean, you've seen it in equity markets, down on this double bottom at 1800. If you are long now in the S&P, you will be worried. I'm sure you've got that key level at 2050. Where are we going to move from here in equity markets? Well, it depends on Friday. We've got non-farm payrolls, depends on the dollar, as I'll talk about. But you saw this in oil, this type of trading environment throughout the beginning of the year, where if I go to, I'm on a daily chart, if I just show you here, from the 1st of January to mid-February, almost every day saw a plus 5% or more move in the oil price. Here we're seeing daily moves in the oil price of over 5%. This green candle here is almost 10%. I look at these type of dojis here. So trading in this environment, you do have a lot of opportunity if you're getting on one of these moves. But what you have to be absolutely focused on is when to get out and when to then take a step back and watch and see what happens. But the psychological challenge trading in this type of environment is, let's say if you're caught offside on one of these 10% moves, your experience has shown you that actually these moves are just reversing the next day, so why not hold on? And that's where it gets really confusing, and that's where it gets very dangerous for your P&L, in that if you're not onside on one of these sharp moves, then where do you take the position off? And it gets so much more complicated because every day you've seen that move reverse, but will it reverse today? Will this be the same thing. Will today be a day where it also reverses? It's okay if you change your risk limit, if you're going to be even more offside. I don't know. I think discipline more than ever before is important, but then it's been very frustrating when you have been taken out of one of these moves and only moved to go the other way. So as I said, Friday is really the main event. What is the Fed going to do? As I said, we had a dovish Janet Yellen followed by nothing but hawkish speakers all of last week. The next live meeting is in April, where she may reiterate, or she may now reiterate a strong signal for a hike next month. I just don't believe it. The odds of an April hike are now just 6%. Odds of a June hike now just 38%, which is more or less where we were since the last FOMC meeting. So especially if you look at the euro dollar, these hawkish comments coming from other members haven't done a huge amount. Let's have a look at the 10-note treasury bond as well. We're trading up towards the high still of the range, aren't we? So if you think about all of the dovish commentary that came out last week, and if you think about ultimately what impact has that had on the euro and T-notes, perhaps it's just tapered the move higher that we would have had in these products, but certainly it hasn't had a lasting effect. Whilst we're looking at T-notes, 129.14, 129.15, can you see this level on my chart? This is interesting. 1, 2, 3, 4, 5, 6, 7, 8 tops on this level at the top of this range. If we want to see where we go above that, we've then got a very nice target, and just go to continuation, see if that's the same. Not helping me very much actually. We've then got a very nice target at 129.22. Can you see that in March? Before then, we get back to February's levels. So this move higher in T-note prices, not yields, is obviously really compounded by the risk-off, global risk-off that we've seen. Equity markets have since recovered that whole move, which is why T-notes came under pressure. But if T-notes can get above this quadruple resistance that we've seen throughout March, we've got 129.22 ahead of that. And then we're again back in this space where we were in February. And this is absolutely my view. I do not believe that the storm is over. I think what we've had, very similar, if you go back to what Piers was saying on CNBC in February, and I'll put the link back in the room, this is the calm after the storm, before the storm, in my opinion. I think many of the reasons why equity markets fell off earlier in the year, these are not fixed. I mean, the only one you could say that is fixed is the rebound in oil prices for now. One of the other main reasons was the weakening renminbi. One of the reasons, therefore, for the rebound has been that you have seen a trend of strengthening renminbi, but that got taken away to a large degree last week. So that's not in there anymore. If you're talking about data and global growth, that's not there. Okay, 1 second. Test, Rabia. I'm back, I hope. Okay, good, thank you. Yes, I was just looking actually on my other screens here. If you wanted to see there what Piers was saying, so this was back on the 17th of February. I put that link to CNBC in the room there. This is back on the 17th of February, saying, look, we expected some consolidation here. The sell-off, and I agree with him, was pretty strong, pretty fast in risk assets, but at the same time, this rebound, in my opinion, has overshot as well. And this is what you get with these behavioral markets, where you overshoot on the downside as everybody crowds into the trade, you overshoot onto the upside, but ultimately, apart from the rebound in oil prices, not too much else has changed, I don't believe, for the equity market picture. In fact, I think potentially, let's see what happens on Friday, but if the Fed stay dovish, if the Fed do stay dovish, then much like we saw in September, rather than there being a positive equity market outlook on that dovishness, it really begs the question of, well, what do central banks do now? We've already seen it in Japan, where they eased more than expected and the yen strengthened rather than weakened. We've already seen it in the ECB, where Mario Draghi did more than expected and the euro strengthened rather than weakened. It's just the Fed left now for the market to say, no, I don't believe you. I don't think you've got any bullets left in your package. Okay, just in other news then, I was actually writing a session. I've got a webinar coming up with CQG in a couple of days. This is on the 31st. Have a look at that if you can. And I was preparing for this webinar over the holiday break, and also using it for a sovereign wealth fund that I'm working with in a couple of weeks. One of the things that I wanted to highlight was one of the impacts of something called anchoring. Now, just to share this with you before I finish for the session, before we just talk about the data, and I'll close this session. When you look at the oil price like this is I think quite interesting. When you look at the oil price like this, you know, it says this chart says to us that what should the price of oil be? Well, for anybody that's traded for less than 5 years, you know, you've got the price of oil set really in your psyche at around, or this is what was happening, certainly when we started having this oil sell-off. You know, this should be the price of oil, $100 or around $100. People have anchored that price as their perceived value of oil. If you just change this chart slightly, and I'll be interested if you could do this on other products as well, if you change your reference point. So here I've got a chart looking at oil, and here we're looking at oil actually rather than at the bottom of the range. This looks just interesting to see. This looks as oil, actually rather than the bottom of the range. If we just move the chart up slightly, oil's actually at the top of the range, if you like. Well, there you can see the first Iraq war creating the top of that range, nice and clearly going from $15 to $40 a barrel and then quickly back again. But it's interesting just trying to look at charts with a different perspective and excluding 2005 to 2015, so excluding 10 years, in the last 30 years, we're really back at the top of this range. Okay, so let's have a look at the data coming out today. I do still expect it to be quiet. You'll find this HotCom room at Amplify quite quiet as well today. You know, a lot of people won't really be in till this afternoon. Data-wise, we've got data coming out in the UK. Data is coming out just at 2 o'clock now. So we've got, sorry, my chart keeps disappearing. US consumer confidence coming out at 3 o'clock. Sorry, one moment. I can't seem to share that. Just let's have a quick look at this US consumer confidence coming out at 3 o'clock. Before that, at 2 o'clock, we've got Case-Shiller. So Case-Shiller is one of the big housing market indices. That will have an impact on equities all as we lead up to the non-farm payrolls data release. But otherwise, it's pretty quiet. It's been relatively quiet this morning as well. So bear that in mind. A lot of people will be slowly coming back to their desks. It's still going to be light market volume and trade that market accordingly. Okay, guys, so that's it from me. Welcome back. I hope you've all had a good Easter break, some time away from the screen. Certainly, I feel refreshed and ready to go. Not nearly so bleary-eyed and looking forward to it. Non-farm payrolls read, that'll be on Friday. It's all about the Fed. Hawkish or dovish, they're giving mixed signals at the moment, which is really just what they want to try and keep us on our toes. Okay, good luck, guys. I'll see you in the room. Thank you.